Good day, everybody. Jeffrey Beamer here, Senior Investment Strategist over at ewotrader.com. Welcome to our little Monday show here on Delta Neutral Trading. We have a big show for you here in a very small window of time. So what we're going to cover today is we're going to review our trade from last week, which was on Paychecks. We're going to touch on market-moving headlines, potential market-moving headlines. Then we're going to talk about the charts, see where the market's going, and then we have a new trade idea for you this week. So let's get into it. Let's take a look at old Paychecks here. How did we do on that trade? Well, this was a earnings-related trade on a stock that we would think would not move very much. And so what we will do, instead of placing a straddle or strangle on the trade looking for a breakout, what we're looking for is consolidation through the earnings, which is what we got. So if you look at the chart here on the left-hand side of the page, you'll notice a big candle here with an E above it. That was the earnings date. The stock gapped down on the news, but then rallied throughout the day. And look where the stock ended up. The dark blue line that you see here is it's dissecting the current price. This is the latest price today when this image was snagged. Okay, it is sitting right there at 123, which is, this $123 mark is right in the middle of our iron condor. Now, I included what the initial credit was. We took in $1.40 on this trade. We risked $360. Now, when you put that into perspective, this is based upon a hypothetical $10,000 account. So the maximum reward potential is $140 on $360 risk per spread. Okay, well, we go through earnings, we have a collapse in implied volatility, and boom, we are now sitting with a profit of $128, which that is well over 90% of the maximum reward we can take. So we might as well take profits in this and move on to the next trade. And if you're thinking, oh, wow, $128, no big deal, we'll realize that based upon the account size that we're talking about, that is a 1.2% return on portfolio in just 7 days. Okay, a 1.2% return on portfolio in just 7 days. So when we rinse, repeat these over and over and over again, then that's when the return on portfolio makes a big difference. All right, so that's it for Paychecks. Let's move on to some of our headlines for today. It's going to be an interesting week after last week's roller coaster, because this week could be bumpy as well. We have several things going on, so let's talk about what we're looking at. We're looking at Wednesday, we have an FOMC meeting. Now, we pretty much know what's in the meeting minutes because of what's been talked about after last week. So there shouldn't be really any news there. But then we have the CPI, which is the Consumer Price Index report, on that same day. And then on Thursday, we have PPI, which is the Producer Price Index, and initial jobless claims. Now, those can be, those can cause a little ripple in the outlook for the Fed and which way interest rates are going and which way interest rates are trading. And there's a couple of other things happening. One other thing is the 30-year bond auction is going to happen on Thursday. And this is going to be a test for investors' tolerance for risk, okay? So if there's weak demand and they have to raise interest rates on that 30-year, this could keep the Fed from cutting rates anytime soon. Now, I've been pretty much stand fast on my opinion that we wouldn't have rate cuts until June at the earliest. I've been saying that since January, and that we would only have 2 this year. Now, compare that to Goldman Sachs, which was saying that originally there were going to be 5 rate cuts this year, and now they're down to 3. I still don't even know if we'll get that many rate cuts this year, but we'll see. The first one in June, I think, might be a gratuitous 25 basis points, but we'll see about that. Now, in addition to that, we have earnings season that it's pretty quiet for earnings this week. However, Friday I would say that's this week is the kickoff to the new earnings season, because Friday we have some of the bigger banks declaring earnings. We have J.P. Morgan, we have State Street, and a couple of others. We'll take a look at that in just a moment. All right, so those are the headlines for today, and it could be an interesting week. So let's jump over to the charts and see where we're trading today. This is being here on a Monday. This is beginning of the week, and we had a nice rebound on Friday. If we take a look at the broader markets, this is the Spider Index Trust, SPY. This is our proxy for the S&P 500. And you can see here, as I zoom in on the chart a little bit, that we have we crept back up above that short-term moving average. Now that's the 21 period moving average, and we are trying to climb back into the channel. All right, so this is still kind of a bullish profile. We do anticipate market kind of going higher. If we remain on this trajectory, we could be up at 530 to 540 on the Spider by the end of April, maybe early May. So nothing is derailing us from that right now. So we remain bullish. Now let me jump over to the Hike and Nishi candles, because I use those to help identify trend. And you'll see here that these red candles that came in they have wicks on the tops and bottoms. That means it represents indecision. And so even though the market was pulling back, it was still without conviction. And now today we're getting another green bar. So holding that, as long as we hold that short-term moving average and we remain green on the bar, then we should be good to go. Now jumping up to the NASDAQ and the QQQ, really this is a sideways chop. We've now been trading sideways for 2 months now. The bias is still bullish. However, this sideways trade up here at 440 is proving to be a pretty good resistance here. I'll bring it back to my regular candles. And as you can see here, as I zoom in a little bit, we have the short-term moving average now beginning to dissect price and flatten out. That flattening out just represents that a market that is starting to trade sideways. And we will see. We need probably this earnings season that's up and coming, maybe to light another candle under the NASDAQ, or will be this be the one that really chops the NASDAQ and these tech stocks at the knees and starts bringing the market down. Only time will tell. Now we go over to IWM. This is the Russell, the small caps. Has been pretty volatile, but we have pretty much the same type of action now since early March, late February, early March, where we're just trading in a range. We seem to be stuck here at this 205 mark, trading between 200 and 207. The bias is still bullish. As you can see, it hasn't broken the upward sloping trend line that I have drawn here, but there is a lot of chop. And part of this has to do with interest rates and some other factors. But again, with earnings season right around the corner, we start really picking up on this in the next week or so on these earnings announcements. That will include the small caps, and we'll see where they go. Now, jumping over to some other markets, let's talk about oil for just a moment. We're finally getting a little bit of a breather today. Oil USO, our proxy for oil, is down a little over 1% today, and giving us some relief from this sharp rally. We burst right out of this pennant. It was a very small short-term pennant that we had formed, but this was a strong rally, and now we are pulling back. We will see how far we do pull back. I could mark that up and probably give an idea. I want to do a different one here. Let's do this. Oh, that's my that's the one I want. I want retracement. Sorry. All right, so we'll bring this over here and do that, and let's see here. So we are looking at probably a level pullback here, somewhere around 78 to $80 could be a pullback that just doesn't upset the apple cart too much. All right, just off of this little pause here, and we drew our retracements, and just that 50%. And actually, I drew this upside down, but we'll work with that. The levels will be very similar there. So okay, let's move on then to gold. Let's move on to the metals, because gold is up once again today. Gold is up 7% off of our when we called out gold a couple weeks ago. Remember, we were talking about this this wedge, and we were here right around these dates right here at the end of March, and I talked about increasing your exposure to gold, and if you already had exposure, maybe even increasing that even more. And within a day or two, the market took off and rallied up here, pretty sharp rally, up 7% in a very short period of time. But that pales in comparison to silver. They were talking about all the talking heads were talking about how silver was trailing gold. Well, I would call this is an 11% move off of this low right against where price is hitting my short-term moving average here. Okay, this candle right here, this second green candle, that's coming off of that moving average. This is an 11% move up to today. Now, we showed a little weakness earlier in the day, but as we get to midday today, silver is rallying back up, and it is positive on the day, up over 1.1% compared to gold, which is up 11 basis points. So silver is no longer trailing gold; it is leading right now, and it continues to, I would think it continues to move higher. Here's a good example of where Heiken Nishi kind of comes in and identifies trend. I mean, we can see that the trend is up, but what gives us, if you were concerned that say that this candle is oh, this is a doji, or this is some other thing, well, just bring in your Heiken Nishi candles, and you could see that, oh, this is just another candle in a big uptrend for silver right now, and it's looking like it could possibly hit 27.5. It's got some resistance up here at 26.5, but we'll see if this rally continues. All right, so let's move over then and look at interest rates real quick. We'll talk about TLT. Look at this. I have my Heiken Nishi candles on, and we are pressing lower. In fact, since I looked at this about an hour ago, we are down even lower. We're down 24 basis points. If we close down here, this will be a fresh low, okay? Fresh recent low. And this is a pretty ominous sign, because there is lots of open space down here. And, if we come back down and test 8250, which is our previous major pivot down here, this can be a big problem for the market. Okay. So rates, this is meaning rates are a little higher. They are higher. There is a silver lining in this, but we'll get to that in a moment. But this is really an ominous chart for rates, okay? Meaning rates are higher, bonds trading lower. Now, the short end of the curve, okay, so TLT, which you're looking at right now, in fact, I'll put my regular candles back on, all right, so you can kind of get an idea of what today looks like. All right, so this is the long end of the curve. This is the 20-year plus treasuries. If we go to a shorter term, SHY is the 1 to 3 year treasuries, and it is also showing low recent print. Okay, at 81.32 is its current trade as we're talking. That's down about 8 basis points today. Okay, but it's facing kind of the same thing. I mean, this is quite the potential drop as far as technicals are concerned. Okay, now if I put my Heiken Ashi on, it will confirm that just a big strong red candle here, and we will see where we close. I mean, the closing is the most important number of the day. Now, with TLT being down 19 basis points and SHY only being down 8 basis points, here's where the silver lining comes in. If we advance to our next chart, which is the inverted yield curve, we see a dramatic flattening of the curve over the past week. Since I came to you last week, the long end of the curve has rallied. Okay, so the long bonds have rallied in rate faster than the short-term rates have rallied. Okay, and we have gone from about 1.37 last week to 1.04 today. I know that was a collapse. I think the collapse actually was 22 basis points, which is pretty significant. All right, so it would have been 1.26, I believe, last week. So the flattening of the yield curve is a positive, and we'll see how that translates. But I think that isn't really going to matter if that 5-year, which they're really looking at, the 10-year, they're really looking at that, saying if that gets up to 4.8, and we're, I believe, at 4.4 right now, that gets up to 4.8. I think that market starts to get a little nervous with that. And of course, if we get to 5, that'll cause all sorts of problems in the markets. So we'll be keeping an eye on the bond. Normally, we don't focus on bonds, but boy, today and this period of time, we really are focused on bonds and what rates are doing. All right. Now, one last one is the more kind of the mortgage rates. 30-year mortgage. Let's see where the national average is. The national average is currently around 7%. We're seeing, one thing about this chart that you'll notice is the blue line is a daily rate, and the gold and the gray within this chart are weekly calculations. All right, so it's a little faster moving, and you can see we ticked down here recently to 7% on the latest reading, and that's the Mortgage News Daily average that is used. And really, it's since the beginning of the year, we are the 6.8 to 7.2 window is the range where mortgage rates have been holding steady. So I know that there's all sorts of housing issues in different parts of the country, some positive, some negative, and it's a very interesting dynamic right now. But mortgage rates, I think people are starting to digest this higher rate, and they're realizing, you don't marry the rate, you date the rate. Okay, and you're buying, you marry the house, so to speak. So anyway, that's where mortgage rates are headed. So, where do you think rates are going? I mean, I'm convinced that we're higher for longer and rates are going to continue to rise. But what do you think? Let us know in the comments where you think rates are going, because and attach a win. I think that's the critical thing. As option traders, we have to put a date on it because options expire. So we tend to be a little bit more, a little better traders, because we can't just say, a stock's going to X dollars and then leave it at that. We have to say the stock's going to X dollars by X date. All right, and that's what sets option traders apart. So speaking of stocks, let's jump over to our earnings calendar. It is a quiet week. We have 198 companies declaring earnings this week. Those are kind of overall, and then even fewer that are that we're focused on that are most anticipated by market cap and by option volume. Really, other than probably, there's a few names on here. Delta has been, it has earnings Wednesday. That company has been in the news. That might be a stock to watch on Wednesday. In addition to we start off the day with the initial jobless claims, and then we have the FOMC meeting minutes, and then but by then Delta has its earnings announcement in the morning before market open. So that will start off the day. We'll see what happens there. And then Thursday, I'm hearing all sorts of stories about CarMax right now. They have their earnings announcement Thursday morning, and just a lot more, a lot more CarMax vehicles showing up on the auction blocks from repos. So a lot of repos. So we'll see what happens there. And then Friday, don't mean to bury the lead, but Friday's the day. We have JP Morgan, we have Wells Fargo, we have BlackRock, and State Street, Citi, big banks, big players in the financial industry, all having earnings on Friday. And I would declare that Friday, April 12th, is really kickoff for the next season of earnings. We just finished about 2 weeks ago with that January-February cycle. It trickled into March. Well, now we're ready to start again, and you got these big names having this earnings event on Friday. So out of this, believe it or not, I'm focused on another bank that doesn't have its earnings until next week. All right. And so the trade that we're going to be focused on, we're doing it a little bit in advance, and that is Goldman Sachs. All right. So our trade of the week is Goldman Sachs. An interesting thing about Goldman is that it typically moves very little through earnings. In fact, its average is about 2 to 3%. Okay. The company is so big and the financials so diverse that really earnings are not a big event for Goldman. And so what you see here in the chart, you can see all the sideways action that this stock had in the past. It just kind of was at 382, chopping up and down between I would say 375 and 390 was its range. Okay, that $15 range, and then the range kind of got elevated between 380 and 395. Okay, and then this little pop here. What this little pop is not earnings. This little pop was about that same time they had almost $1 billion in capital raise, I believe, or funding approved for something. I don't remember the exact headline, but it was the market looked at that as very positive, and the stock gapped up. And I know a lot of analysts raised the price estimates on Goldman, but the fact is that implied volatility on the options is now getting a little high, and we have earnings next week. So what we'll do then is come to you next week, and we'll talk about what we're doing with this particular trade. So similar to what we did today with Paychecks, and we rode that through earnings. We'll be doing that again for next week and see where this thing goes. So that's it for today. If you like the content that you're getting here, please like and subscribe. And then also, if you would like to know how we trade through these earnings events, and we are having stocks come up that are big movers. In fact, I think CarMax might be one of those big movers, okay, that we could see on Thursday. You can subscribe to our free guide at ewotrader.com/straddle. And that will help you navigate those stocks where we think a big move is coming. So that's it for today. Hey, everybody, have a great trading week, and we will see you again next week. Take care.